Hello and a very warm welcome. If you're running a business in the UK, you know that investing in your growth is absolutely essential. So today, in this discussion, arranged by the fantastic team at ProTax Accountant, we're going to break down one of the most powerful tax tools you have at your disposal, the Annual Investment Allowance. Let's get right into it.
You know, it's the classic catch-22 for any business owner, isn't it? You need that new piece of kit, that upgraded software, that new machinery to get ahead, but the cost can be a real sting, and the tax implications? Oof. So the big question is, how do you make those crucial investments without taking a massive financial hit? Well, the answer really boils down to this number right here, £1 million. That is the amount of tax relief that the government has made available to businesses like yours every single year. And it's not a temporary thing, it's permanent. It's an incredibly powerful solution designed to solve that exact problem we just talked about. So, our first stop is getting to know this tool. We'll call it the AII, which stands for Annual Investment Allowance. Okay, so what exactly is this £1 million allowance? And more importantly, why should it be on your radar? Why does it matter so much? In plain English, the AIA lets you subtract the full cost of certain assets from your profits before you even think about paying tax. And here's the kicker. You get to do it in the same year you buy the asset. This isn't spread out over years. It's an immediate, massive boost to your cash flow. Let's make that real for a second. Imagine your limited company shells out £500,000 for new machinery. At a corporation tax rate of, say, 19%, the AIA could save you £95,000 in tax. Just like that. That's £95,000 that stays in your bank account, ready to be reinvested or used wherever you need it most.
All right, it sounds good, right? But now for the practical stuff, who actually gets to claim this and what kind of purchases count? Let's dive into the rules.
And here's the great news. This isn't some exclusive club. The AIA is available to most businesses here in the UK. So whether you're a sole trader, you're in a partnership with other individuals, or you're running a limited company, you are eligible to make a claim.
Now, the key phrase you'll hear is plant and machinery, and that might sound a bit old-fashioned, but it covers a lot more than you might think. We're talking about the obvious stuff, like computers and office furniture, but it also includes heavy-duty factory tools, and even things like installing a new kitchen or CCTV system. What doesn't count? Well, most cars are out, as are buildings and land, and you can't claim it on things you lease.
Let's put this into a real-world scenario. Meet Rhiannon, a baker. She's a sole trader and she needs a new industrial oven that costs £50,000. Because of the AIA, she can claim that full amount against her profits. If she's a higher rate taxpayer, that's an immediate tax saving of £20,000. For a small business, that is an absolute game changer.
So, you know the basics. You know who can claim and what for. Now let's get into the strategy, how to do it right, and, just as important, what common mistakes to avoid.
The process itself is actually pretty straightforward. You figure out what qualifies, keep track of the dates, fill out the right boxes on your tax return, and this is so important, you keep really good records. HMRC can and does check these things. So having every invoice and receipt filed away for at least 6 years is absolutely non-negotiable.
Now listen up, because this is a major pitfall, especially for businesses with a more complex setup. If you run a group of companies that are connected, you don't get £1 million for each one. Nope. The entire group has to share one single allowance. That means you've got to plan very carefully how you allocate it.
And what about when you sell an asset you've already claimed AIA on? Well, you have to be ready for something called a balancing charge. Think about it. You've already written off the entire value of the asset. So if you then sell it, that money you get back basically becomes taxable profit. It's how HMRC claws back some of that tax relief you got earlier.
Here's another tricky spot: mixed-use assets. Let's say you buy a van. You use it for deliveries, but you also use it for personal trips on the weekend. You can only claim the AIA on the bit that's for business use, and you'd better believe you need to prove it with something like a detailed mileage log. Good records are your best friend here.
Okay, let's wrap this up by looking at how these savings really crystallize depending on how your business is set up.
For a limited company, the impact can be huge. A £600,000 investment in machinery could slash your taxable profit from £800,000 all the way down to £200,000. The result? A corporation tax saving of over £100,000. That is serious money.
And for a sole trader, the savings hit much closer to home. They reduce your personal income tax bill.
So a £40,000 spend on new tools could literally cut your taxable income in half, saving you £16,000 if you're a higher rate taxpayer.
So, to quickly recap the big points, the AIA is an amazing £1 million allowance that gives an instant cash flow boost to most businesses. But to use it smartly, you have to keep excellent records, and you have to know the specific rules about group companies and what happens when you sell an asset.
And that really brings us to the final question, which is for you to think about. Now that you understand just how powerful this tool can be, is your business actually set up to take full advantage of it? Is your tax planning truly aligned with your investment strategy?
Look, because the rules can be complex and the financial stakes are so high, getting expert guidance is honestly the smartest move you can make. We'd like to thank Pro Tax Accountant again for arranging this discussion. For personalized advice tailored to your business, you should absolutely get in touch with them.